In the last video, we talked about how the tax code rewards ownership, not labor, and why that matters more than politics. In this video, the focus is on how that reality shows up in everyday life. Because one of the biggest sources of frustration people have with the system isn't simply that they're taxed, it's when they're taxed and how little control they have over it. That difference, control, explains almost everything. When you earn income from a paycheck, the tax system treats that income as complete. The work has already happened. Value has already been created. The cash flow is immediate and predictable. So the system taxes it immediately, before you see the money, before you decide what to do with it, and before you can reposition it in any meaningful way. That isn't punishment, it's certainty. From the government's perspective, labor income is the cleanest and most reliable tax base that exists. It's easy to measure, easy to withhold, and doesn't depend on future outcomes. That's why labor is taxed first. Capital behaves very differently. When you invest capital into a business, real estate, or a long-term asset, the outcome is uncertain. The value hasn't been realized, the risk hasn't played out, and in many cases, the return may never materialize at all. So the tax system waits. It allows deferral, it allows recovery of basis, it allows deductions tied to risk, and it often allows preferential treatment when gains are eventually realized. Not because the system favors investors morally, but because capital is productive only if it's deployed. Tax it too early and you discourage risk. Discourage risk and you slow growth. So the system taxes capital last after outcomes are known. This is where people usually miss the point. The issue isn't just tax rates, it's control. Labor income gives you almost no control over timing, character, or treatment. Capital gives you options. You can choose when to sell. You can choose how to structure. You can choose whether gains are realized, deferred, or offset. That optionality isn't a loophole, it's the incentive. The system is designed to say that if you're willing to take risk and wait, you'll be given flexibility. If you need certainty and immediacy, the trade-off is higher taxation. That's not ideology, that's design. This framework feels unfair to many people because most are trained to operate only on the labor side of the system. They're taught how to maximize income, not how to reposition it. They're taught how to negotiate salary, not how to accumulate assets. They're taught how to budget, not how to structure. So when they see someone else paying less tax at a similar income level, it feels rigged. Emotionally, that reaction makes sense. But structurally, what's really happening is that two people are playing entirely different roles in the system. One is a participant, the other is a supplier, and the system rewards those roles differently. The tax code isn't making a moral statement about who deserves more. It's making a functional statement about what behavior it wants more of. It wants capital deployed, it wants long-term investment, it wants people willing to take risk without guaranteed outcomes. If you remove the emotion and focus on the mechanics, the picture becomes much clearer. The frustration isn't about fairness, it's about positioning. Once you understand this, the debate changes. The question stops being why labor is taxed so heavily and becomes why more people aren't taught about how to move beyond labor alone. Because the tax code has never hidden its preferences. They've been consistent the entire time. In the next video, we're going to talk about why business owners and investors operate in a fundamentally different tax reality, and why that gap has widened over time, not to glorify one side, but to explain the system as it actually exists.